Okay, here's the deal. Nobody likes closing costs. I've never ran into somebody that said on a real estate transaction, man, I can't wait to pay me for them closing costs. But you can understand what closing costs are. And after this video, you're gonna be able to do exactly just that. I've got my Dooley whiteboard ready, as always, to fully explain everything and make sure we understand and make sense of where these closing costs come from, who's responsible for them, and what they actually do. So go ahead and smash the like button right now because it's gonna be helpful information, and then we're gonna get right into it. Okay, let's jump right into it. Closing costs. I think the best way to make sense of exactly what closing costs are is to break it down section by section so that you can follow along whether you're looking at a loan estimate or a closing disclosure that your lender has provided you. So let's start with Section A. Section A is called origination charges. Another name for that is basically lender fees. This is where the originator/lender is charging you for their services. So the first thing you'll typically see here is the percentage of loan amount associated with the interest rate. This is the cost for the interest rate that you're getting. Now you can also choose a higher interest rate if you're seeing a fee here and eliminate that cost most of the time. It really depends on what the lender's rates are and what they have ranging on their options of interest rates. But generally speaking, the lower rate that you ask for, the more cost it's going to be associated with that rate. If you take a higher rate, then you're going to see a lender credit that will show up under Section J, and we'll cover that a little bit more later in this video. Other items that you'll see here are things like an underwriting fee, a processing fee, or a broker fee. But ultimately, the items that are disclosed in this section are determined by the lender and or broker that is providing the loan to you. Now, let's move on to Section B. Section B is going to be services a borrower cannot shop for. And the reason that is the case is because the lender has ultimately determined who is going to provide these particular services for you that show up in this section. So ideally, you'll see things like an appraisal fee. That's because the appraiser is being chosen by an appraisal management company that the lender has chosen to work with. These fees will go directly to the people that are doing the services and or the companies that are providing the services. There isn't anything shared with the lender that is associated with these fees, but ultimately you cannot shop for them because the lender is the one that chooses the servicers and the individuals that provide the fees. Let's move on to Section C. Now, Section C are services the borrower can shop for, and that ultimately means that you have a say, if you want, in who is actually going to provide this service. Typically, what you're going to see in Section C are title fees. Unless you're in a state like California, where they sometimes have a separate company provide the escrow fees and the escrow services, but a lot of times escrow and title are bundled within the same company. The main item that you're going to be paying for in this section is the lender's title insurance. And that's because anytime that you're purchasing a home with a lender providing you a loan, you are required to have title insurance with the lender's name on it because they're your lien holder. But a title insurance policy is supposed to protect you and the lender in the event that someone tries to take claim of your property and say that they have title to it. That's ultimately what you're paying for with this service. Now let's move on to taxes and other government fees that you'll find in Section E. This is ultimately determined by the county and the state that you're in. It's going to vary with the terminology, but you'll see things like recording fees, state tax stamps, mortgage tax to a county clerk, transfer taxes, but ultimately this is determined by the county that you're in, and it's basically charges for them having to record and update their paperwork and documentation for you now being a new owner of the property in their state and county. Section F is prepaids. Now, if you're purchasing a home, you're going to see a homeowner's insurance premium for an entire year's worth in this section. That's going to go directly to the company that you have chosen to provide your homeowner's insurance coverage. Prepaid interest is also going to show up in this section. And the easiest way to think of prepaid interest is, let's say you close on March 15th. Lenders will allow you to skip the month of April and your first payment is going to be May 1st. While prepaid interest is paying for the gap between March 15th and the end of the month before your full month of payment starts. So ultimately, it's going to vary depending on the date that you're closing your loan on. Section G is your initial escrow payment at closing. Now think of this as your own money that's set aside in a separate escrow account with the lender as a cushion, because ultimately what's going to be taken here is insurance and taxes 2 months worth. Most lenders are going to require a minimum of 2 months worth. And that's because if you're escrowing, meaning you're allowing the lender with their escrow department to pay your insurance and tax bill once they're due, they're going to want to have a cushion for those bills in case there's a change in those bills, increasing the taxes or insurance at the end of the year. If you ever refinance or sell your home, the amount that's sitting in escrow as a cushion will be refunded back to you. Section H is entitled Other, and this is referring to any miscellaneous items for your transaction. Things like an HOA reserve fee or a condo questionnaire fee. But a lot of times what you'll see here is an optional title owner policy, which is not really something that you need to have if you already have a lender's title insurance. But if you were to ever pay off your loan and own your home free and clear, it's something that we definitely recommend getting. Now I skipped section D and section I because all that's doing is adding up the fees in each of its columns. And under section I, you'll see section J, which will total all of your closing costs. And under section J, you will have any applicable lender credits, and that's going to be mostly associated with what you're choosing in your interest rate. Now, calculating cash to close is going to break down your overall amount of funds that you're required to bring for your closing. So it's going to add up your total closing costs in addition to your down payment. It'll subtract the earnest money that you've already contributed to the deal, in addition to any other type of credits or rebates that you're getting on the deal. Things like seller concessions if it's applicable, real estate agent rebates, any other adjustments that come from prorations from the seller in taxes and things like that. That'll all get added up and calculated and giving you a fixed total of what you're supposed to bring for your closing. And that, my friends, is the breakdown of closing costs and your cash to close.